Now I went around the complex and I borrowed some phones for today's video. The point I want to make today is this. I see a lot of people that walk in here with individual stock portfolios, or they'll have brokerage accounts with lots of individual companies. And the fundamental mistake being made is, a lot of people will think, well, what I'm going to do is I'm going to hire this broker, or I'm going to myself try to figure out which companies to invest in. In a lot of my other videos, I debunk that myth that's possible. Even professional managers that do nothing but eat, breathe, and sleep the stock market can't outperform the areas of the market that they're actually investing in. So, that's something that we've talked about quite a bit on previous videos, so I won't go there again. But what I do want to address is the level of risk when you do that with an investment portfolio. One study actually went back to the 1930s and 1960s. Then it took that period of time and it compared it to the 1960s and 1990s. What they found was that the stock market is no more volatile than it used to be, back in the early days, but individual companies are. Why? Well, a company will come out with a product nowadays, and it isn't long before their competitors come out with competing products that do similar things that their products do. So what'll happen is a company may have the lock on a particular product for a short period of time, but that doesn't last very long at all. Think about the e-readers and think about the the iPad and companies that are coming out with competing products with Apple, and it's not long before they're going to be taking up market share. Now, let's bring back the stock market to a basic fundamental tenet, and that is that when you buy stock, you're buying it off of a company in an IPO, and the company is going to try to get as much money out of you as they can. They're going to try to get as much money, or their biggest price that they can out of you for the level of earnings that they're going to give up. Or when I buy stock off of another owner of a company, when I buy stock out in the open market, they're going to try to exact out of me the biggest price that they can for the earnings that they're going to give up. And what happens is that, if you think about it, because of this process of supply and demand and the buyer trying to get as much out of us as they can, and me trying to pay as little of a price, the expected return of holding a single large growth company is no greater than if I own all large growth companies. Now, why would I go and do that? Why would I go and invest in a single company or a small group of companies when I know I could get the same expected return for owning all companies with a fraction of the risk? That is a really important concept to keep in mind. Now, another way to illustrate it is to look at the Dow Jones Industrial Average. These are the most important companies of our time. These are the powerhouse companies, the important companies in our economy. Well, let's look at some of the original companies in the list from back when, the 1920s, 1930s. American Cotton Oil, American Tobacco, Distilling and Cattle Feeding, Tennessee Coal and Iron, U.S. Leather, and National Lead, and American Beet Sugar, and American Can, and Baldwin Locomotive. Now, those companies seem kind of like dinosaurs to us now. How many companies that are important now that people are investing in their individual stock portfolios are going to seem like dinosaurs just 20 years from now? That's the problem with individual stock investing, and that's why we don't want to do that. No expected and no real benefit of doing it, so it's something that you really ought to avoid as an investor. We'll catch you next time.